Something important is happening in the global financial markets right now. Investors across the world are paying extremely close attention to signals coming from the Federal Reserve because the decisions made there can influence the direction of the entire global economy. Stock markets move, bond yields react, currencies fluctuate, and commodities like gold and oil respond to even small changes in expectations about interest rates. For many investors, the biggest question today is simple. What happens next? Are markets preparing for a period of growth, or are we entering a more uncertain phase of the economic cycle? Understanding the forces behind these movements is essential for anyone who wants to develop a strong investor mindset. Financial markets are constantly evolving systems driven by economic data, investor psychology, government policy, and global events. Every day, millions of investors make decisions based on information about inflation, employment numbers, interest rate expectations, and geopolitical developments. These factors combine to create the movements we see in the stock market. While short-term price changes may seem unpredictable, long-term trends often follow broader economic cycles. That is why experienced investors spend so much time studying macroeconomic signals rather than focusing only on daily price fluctuations. One of the most powerful institutions influencing financial markets today is the Federal Reserve. The Fed is responsible for managing monetary policy in the United States, and its decisions affect not only the American economy, but also global financial systems. Through tools such as interest rates, liquidity management, and economic guidance, the Federal Reserve attempts to maintain stable inflation and sustainable economic growth. When the Fed adjusts interest rates, it changes the cost of borrowing money across the economy. Businesses, consumers, banks, and governments all respond to these changes.
Interest rates might sound like a technical financial concept, but in reality, they affect almost every part of the economy. When interest rates are low, borrowing money becomes cheaper. Companies can take loans to expand their operations, invest in new technologies, hire workers, and grow their businesses. Consumers can borrow money to buy homes, cars, and other goods. Lower borrowing costs often stimulate economic activity and can lead to stronger corporate profits, which may push stock markets higher over time. However, when interest rates rise, the situation changes. Borrowing becomes more expensive for both businesses and consumers. Companies may delay expansion plans, consumers may reduce spending, and economic growth can slow. Because of this, markets often react strongly when investors expect interest rates to increase. Interest rates can also shift investment flows toward bonds and other income-producing assets, which sometimes creates additional pressure on stock prices. For this reason, investors around the world carefully watch statements from the Federal Reserve and its leadership. The Fed chair plays a particularly important role in shaping market expectations. When the chair of the Federal Reserve speaks about inflation, employment, or economic stability, investors analyze every word. Even subtle changes in tone can move markets dramatically because they may signal future policy decisions. Markets are also influenced by inflation, which represents the rate at which prices increase across the economy. When inflation rises too quickly, central banks often raise interest rates in order to slow economic activity and stabilize prices. This balancing act between economic growth and inflation control is one of the most challenging responsibilities of monetary policymakers. But while these economic forces shape short-term market movements, experienced investors often focus on a much bigger picture. Markets have always moved in cycles. There are periods of expansion when economic growth is strong and asset prices rise, and there are periods of correction when markets pull back and investors become cautious. These cycles are not new. They have been part of financial markets for more than a century. Understanding these cycles helps investors maintain perspective during times of volatility. Market corrections may feel uncomfortable, but historically, they have often been followed by recoveries and new periods of growth. Investors who panic during downturns sometimes miss opportunities that appear when markets stabilize. One of the most famous investors in history has repeatedly emphasized the importance of long-term thinking. Warren Buffett, the chairman of Berkshire Hathaway, has spent decades demonstrating how patience and discipline can create extraordinary investment results.
Buffett has often said that successful investing is not about predicting every short-term market movement, but about understanding the long-term value of strong businesses. Buffett's philosophy focuses on identifying companies with durable competitive advantages, strong management teams, and sustainable business models. Rather than constantly trading in response to market headlines, Buffett prefers to hold investments for long periods of time. This approach allows the power of compounding to work over many years. The idea of compounding is one of the most powerful forces in finance. When investments generate returns that are reinvested over time, growth can accelerate Even moderate
dramatically.
annual returns can become significant when compounded over decades. This is why long-term investors often prioritize consistency and patience rather than chasing short-term gains. Investor psychology also plays a major role in financial markets. Emotions such as fear and greed can influence decisions, sometimes leading investors to buy assets when prices are high and sell when prices are low. Successful investors often develop strategies to manage these emotional reactions. By focusing on research, discipline, and long-term goals, they attempt to avoid the most common behavioral mistakes. Another important factor shaping markets today is global economic interconnection. Financial markets are no longer isolated within individual countries. Economic developments in one region can quickly influence markets around the world. Changes in interest rates in the United States may affect currencies in emerging markets, commodity prices, and international trade flows. Technological innovation has also transformed financial markets. Information now moves instantly across the globe, allowing investors to react quickly to news and data. At the same time, technology has created new investment opportunities and new risks. Algorithmic trading, data analysis, and financial technology platforms are changing how markets operate. Despite these rapid changes, some core principles of investing remain remarkably consistent. Diversification, risk management, and long-term thinking continue to be essential strategies for many investors. Diversification involves spreading investments across different assets or sectors in order to reduce risk. By not concentrating all investments in a single company or industry, investors may be better protected from unexpected market events. Risk management is another critical concept. Every investment involves uncertainty, and successful investors often focus on understanding potential risks before making decisions. This includes evaluating economic conditions, company fundamentals, and broader market trends. As investors look toward the future, several key economic indicators will likely continue influencing market expectations. Inflation data, employment statistics, consumer spending trends, and central bank policies will remain central factors in determining the direction of financial markets. Each of these indicators provides insight into the overall health of the economy. For long-term investors, however, daily market fluctuations are only part of the story. The larger goal is to build a disciplined strategy that can adapt to changing economic environments. By studying history, understanding economic fundamentals, and maintaining a long-term perspective, investors may be better positioned to navigate uncertainty. Financial education plays a crucial role in this process.
The more investors understand about economic systems, market behavior, and investment strategies, the better equipped they may be to make thoughtful decisions. This is why many investors dedicate time to learning about financial history, studying successful investment strategies, and analyzing economic trends. In many ways, the journey of investing is also a journey of mindset. Developing patience, discipline, and a willingness to learn can be just as important as understanding financial numbers. Markets will always experience periods of uncertainty, but investors who maintain perspective may be better prepared to handle volatility. Looking ahead, the financial markets will continue responding to economic data and policy decisions. Central banks will evaluate inflation trends, employment growth, and global economic conditions before making policy adjustments. Investors will analyze these signals in order to anticipate potential market shifts. But while headlines may change from day to day, the core principles of investing remain remarkably stable. Understanding economic cycles, focusing on long-term value, and maintaining disciplined strategies have guided many successful investors through multiple decades of market change. In the end, building a strong investor mindset may be one of the most valuable skills anyone can develop. By staying informed, thinking long-term, and avoiding emotional reactions to short-term volatility, investors can approach financial markets with greater confidence and clarity. If you want to continue learning about financial markets,
Investing strategies, and global economic trends, make sure to subscribe to Investor Mindset Markets. Here, we break down complex financial topics in a simple way so you can better understand how markets work and how successful investors think.